we're going to discuss whether or not it's actually possible to add six figures to our personal accounts this year if we're starting with just $130. Um, going to talk about understanding the role of risk to reward. This may be a step backwards for some of us, covering what we already have learned, but it's important that I include it in this discussion because it's directly relevant to the outcome. We're going to talk about our personal capital and how that grows versus prop firm capital. So, when we talk about risk to reward, there are three possible outcomes of trading. You're either going to lose, break even, or you're going to profit. When we talk about risk to reward in trading, most of us are familiar with it by looking at it on, say, a trading view chart, where we understand that a 1 to 3 risk to reward looks like this, where this is the amount of my risk because this is where I'm entering and this is where my stop loss is. This box can fit 3 times into this area. So that's the 1 to 3 risk to reward. Similarly, a 1 to 6 risk to reward ratio looks like this, where this amount of risk is covered 6 times by the amount of reward. In this chart, we're going to look at various win rates and what they mean when it comes to risk to reward. Excuse me, I didn't label these axes. This is the risk to reward, the 1 to 1 area, this column here, and this is the win rate percentage here. So at a 1 to 1 risk to reward, let's look what happens. You have a 20% win rate. You're losing all the way up to a 40% win rate, still losing. 50% you're break even, and then you need a 60% win rate at a 1 to 1 R&R to be profitable. So again, 60%, not 90, not 80, not 100, but 60% with a 1 to 1 risk to reward ratio. Now let's look what happens when we double that. You're not profitable at 20 and 30%, but you're actually showing profit at 40%. Then at the 1 to 3 risks to reward, we're looking at a whole different story here. This shows profit at the 30% win rate because with just one win, that one trade wipes out 2 prior losses and adds profit on top of that. 1 to 4 is even prettier. You're break even at 20% and you're profitable at 30% and above. The higher the win rate, the more the profit, of course. 1 to 5, you're profitable across the board. That means you can lose up to 5 times and still turn a profit. Now, for personal account versus prop firm account money, let's look at the pros and cons of using both of these types of money. With your own money or personal account, I'm using the $130 number. That's where I'm starting at. And let me just say why I'm starting at $130. It's because I had an objective of turning $100 into $1,000. I wanted to know a couple of things. One is, can I do it? And secondly, how long does it take and what does it take? So that's why I'm using the $130 numbers, because I'm familiar with it and I can give you real data from a number that's really close to it. So with this personal account, I'm starting with $130 as a personal account start point. You're going to have lot size limitations. You're not going to be able to trade very much. So your growth is going to be really slow in the beginning, and the profits aren't going to look that great. They're going to be just a few dollars until you build up into the, multiples of 2 figures. So you're looking at like 2, 3, $5 wins up to gradually more. And so imagine the time that it takes to grow an account with those kinds of profits. There's no mandatory test period. So if you don't know what you're doing, you're probably going to fail unless you luck your way into some wins. But eventually, the path is failure. I hate to put it that way, but if you don't know what you're doing and you're using your own money, that's just not a good combination. There are no rules. But you do have, on the flip side, if you are a competent trader, you can have fast withdrawals and you don't have to worry about what's called a rug pull. Like first you have an account and then tomorrow you don't. Sorry. Then the benefit is that you're starting at zero. You're not starting in the negative because you didn't have to purchase anything. With the prop firm, you have the advantage of leverage. You've got somebody else's money and you can make significantly larger trades so that your profits are looking like instead of 1 to 2, 3, 5, 10, 20, $30, now you're looking at profits in the 3 and 4 figure range per trade. You can grow much faster with those kinds of numbers. There's a mandatory test period because you must pass a prop firm challenge. You must pass a verification phase in some of those instances. There are rules. So you learn to trade by rules. You learn to develop strategies and be very methodical about how you trade. A downside is that there's a longer wait for withdrawals. And there's also the very real protection, as we know, of just a complete rug pull. 1 minute you can have an account, and the next minute it's gone because the rules have changed or the firm went under, whatever the case may be. But these are still viable options. Prop firms aren't going away anytime soon. We just have to be pretty methodical and calculative about how we choose them. The other downside is that you start at a negative, and that's the cost of the challenge. But let's look at starting with um, the personal capital. I talked about the growth rate, so we're going to go in detail and look at a table of what the considerations are of compounding this $130. And we're going to try and grow it to $1,000. We're just going to look and see what it takes to grow that $130 to $1,000, and even what it would take to grow that $130 into $10,000. Again, I'm not taking a side. Either side works just fine. Each side has its pros and cons. It's just a matter of your personal preference for how you want to grow your trading capital. For this calculation, I used my FX book. I'll show you that after this. There are several really good calculators, and I just used a simple compounding calculator to come up with this chart. I kind of had to backwards engineer it because I didn't know how to properly do it, but it worked out just fine. These are averages. This isn't carved in stone. This is just an average of what it would take. So the periods here, um, these are in weeks, uh, not months. So it took me about 4 months to compound my $100 into $1,000. So I use that same number as the basis for my calculation here. And so using that calculator, it looked like I would need about over that 16-week period, I would need about a 14.5% gain per period to compound that up to $1,000 in that 4-month period. The complete gain on this compounding 100, or in this case 130 to 1,000, was a total gain of 772%. And so these are what the numbers look like on that calculator with my starting balance of 130. It took 16 periods at 14.5% interest or gain to come up with that $1,000. Now at $10,000, if you're trying to turn that $130 into $10,000, calculation is that it would take about 1.37 or 1.4 years, so that's a year and a couple of months, to grow that 130 to $10,000 at 14% growth per week. And this calculation is not taking into consideration all the normal stuff we do as traders, which is losing, going on tilt, over leveraging. These are just averages. Now, let's look at the prop firm capital numbers and what it takes to grow or compound that $130 to 10,000, even 100,000, and even higher. I looked at developing a prop firm growth strategy based on models that are currently being used in the industry. And here's how that looks with various challenge amounts. If you were to purchase, again, we're starting with our $130, the strategy would be to purchase a $10,000 challenge. The cost for a $10,000 challenge can be between $75 and $130. That's why I use the $130 because that's what I'm seeing the average for most of these $10,000 challenges at. So if you pass with a 10% profit, your payout is approximately $1,000. You would then use a portion of that payout to purchase a $100,000 challenge at a cost of about $490. You use a portion of that payout to purchase additional challenges. You see what we're doing here? We're just kind of compounding, exponential compounding. Now we're trading multiple accounts using a trade copier, and then we're keeping some on the back burner for later. This isn't a straightforward process. There are going to be wins, there are going to be losses. This is just an average and an explanation of the strategy. This also doesn't include all the cool things that prop firms offer, like withdrawal bonuses and 50% discounts and all that stuff. By the way, when they offer 50% discounts, buy two. That just makes sense. Now let's look at the earnings on other accounts. Well, these numbers here, these are actually the costs for the challenge. For a $100,000 challenge is $489, and so on and so forth. This is why I'm saying we use our winnings from previous challenges. When we get those payouts, we don't just splurge or lose that money. We're treating this very much like a business, and those payouts are used to grow the business. All right. Now, let's look at what it looks like when we have a $100,000 account. So at 3% of profit. This assumes that you have passed the challenge and that you're a consistently profitable trader. At 3% profit on a $100,000 account, your payout is $3,000. At 5%, your payout is $5,000, 7% is $7,000, and 10% is $10,000. And these are numbers that can be achieved monthly. In some cases, if you're doing rapid challenges, you can increase that. Of course, if you have multiple accounts, you'll be getting payouts from multiple firms over different periods of the month. So you'd have to structure that in a way that makes sense to you. So in this strategy, you purchase a $10,000 challenge at a cost of between $75 to $130. You pass, and your first live account profits 10%, you get approximate $1,000 payout. You can have that. You really only need, $500 to buy a $100,000 challenge. Then you use a portion of that payout to purchase additional challenges and begin the process of trading multiple accounts. You're going to use a trade copier to make your life easier. And then at this point, you are really looking at what percentage of this growth am I going to assign to my personal trading account? And you're going to feed and build that personal account with the earnings from the prop firm accounts. Do not rely solely on prop firms. We all know how they're looking. We all know of the uncertainty. Make sure you're getting regular payouts and don't leave your money sitting there. Pull it out. Now let's look at the earnings on other accounts and how those numbers look. For an account size of 200, 300, and $400,000, we're going to look at what the payouts look like from various profit percentages. At 3% on a $200,000 account, the payout at just 3% is $6,000, 5% is 10,000, and so on and so forth. I don't need to read all these numbers to you, but you can see that the bigger the account, the bigger the profit potential. And that's why we're getting multiple accounts from multiple prop firms, is because we want to see that exponential growth, and we want to have a clear path and strategy forward for injecting um, 5 and 6 figure profit amounts into our personal accounts. And we're repeating this process and building this strategy bigger. We're snowballing, we're compounding. I would also like to add that when the um, big traders, I mean the $1 million prop firm account holders, when they do this process, uh, they are careful not to risk losing their accounts just to get higher payouts, because at the million, 2 million, $6 million number, just 1 or 2% or even 0.5% is a significant gain profit wise. So they're not trying to attempt a 10% profit. Another reason for that is that they want to try to stay under the radar, because they're noticing that they can be banned for being too successful. So they're milking the process, and they're not getting too greedy, and they're spreading the profit across multiple prop firms. At this point, their primary objective is to just keep the accounts, add more accounts. They're still going to be losing. Even the most profitable trader, even the biggest account holders lose. So the high earners keep this process going. They do it over and over again. They compound and they just keep growing. Now, remember, we talked about risk to reward and averages. And it's important to understand that you can do this. Everyone here can do this. These numbers aren't huge to make these prop firm challenge achievements possible. I'm going to show you an example. This is from my account, and this is a good example of how it looks when you're trading correctly. When you're in the zone, you're nice and calm, you're not going on tilt, and you're just slowly and methodically building. Um, you only need to get up to 10%, and this is on a $10,000 account. I pulled this from my MT4 report after passing. And this, like, look at this equity curve. See how it's consistently going up. It dips a little bit, but it, for the most part, just keeps going up a little higher. And pay attention to particularly two sets of numbers here. This profit factor, this is I believe, I could be wrong, but I believe this is like my risk to reward number right here. So my risk to reward average is about 1 to 4.5. And then look at this number. My average profit trade is only $30. You don't have to risk massive amounts to make these wins possible. So notice here, the average profit trade was only $30. But look, here's what makes all the difference. My percent of these two numbers here, the largest profit trade is higher than the largest loss trade. So we have to practice consistency, and just be kind of even across the board. Use a larger, at least a 1-to-3 risk to reward ratio, and you will get to the finish line successfully. Now let's look what happens when it's done incorrectly. This shows a whole different picture. This is me losing a challenge. This shows psychology. You can see psychology coming into play here. Oh, I started losing. And this is probably, I don't remember this, but this is probably the beginning of me going into a mode of um, probably inconsistent lot sizes, FOMO, greed, revenge trading, and this is clearly revenge trading here. Just larger numbers with bigger losses and trying to fix the problem with the problem. It's complete insanity. This is bad psychology. This is not the way to trade. If you feel yourself going on tilt, you have to walk away from the computer. You have to walk away, step away, gather yourself, and then come back. Don't go into the next day with the same mindset. That's that's the most I can say about this. This is not the way to do it. But look at these numbers. And look, we talked about the risk to reward. The other one was 4.5, 1 to 4.5. This one I'm at a 0.25% profit factor. It doesn't work. It just can't work. The average profit trade was $50, but look, higher than the other one. But look at my average loss, $200. So the moral of the story is develop your strategy, stick with it, use a higher risk to reward, at least a 1-to-3 risk to reward factor in your trading consistently to the extent that you can. It doesn't, in my opinion, prove me wrong when we talk. But it doesn't make sense to me to trade 1-to-1. It just seems impossible to win. I know there are scalpers who do it all the time, but it doesn't work for me, and I just don't get it. But that doesn't mean it's wrong. It's just you've seen the numbers of R&R on that chart and how they work. And at that, I'm just going to end this here and share the resources that I use. The reports that you looked at were generated in MT4 and MT5. I can show you how to do that later. And then I used myfxbook.com